Ever considered the power you wield with every dollar you deposit in your bank account? You, my friends, are the lifeblood of the banking world. Allow me to walk you through this thrilling journey your money undertakes. It isn't simply a mundane transaction of you handing over your hard-earned money for safekeeping. No, it's a dance of economics, a strategic game where every move matters. Every dollar you entrust to your bank propels it into a frenzy of activity. Far from being stashed away and forgotten in a dusty vault, your money is transformed a means of progress. They pay you interest not out of charity, but from a place of shrewd strategizing. Why, you ask? It's quite straightforward. They take your money and lend it out as loans to businesses in need of capital. However, while the interest you earn from your deposit is modest, the interest they earn from these loans is significantly higher. Consider this scenario. You deposit $1,000 in your bank and you earn a 2% interest. That's just $20 a year. Meanwhile, the bank loans out your $1,000 to a business at an interest rate of 10%, raking in a neat $100. This gap, this difference in the interest rates, is where the magic happens. It's the secret recipe to banking success, the real profit maker for banks. Your deposits are the heart and soul of the banking world, the fuel for their lending activities. So, let's up to the plate and keep the lifeblood of the banking world pumping. Banks operate on a system known as fractional reserve banking, a unique concept that may surprise you. You see, when you deposit your money in a bank, contrary to what most of us believe, the bank doesn't keep all of it tucked away in some vault. Instead, they are required to keep only a small fraction of it in cash. The rest? Well, they lend it out to other customers. Fractional reserve banking is a system where banks hold just a fraction of the deposits as reserves and lend out the remainder. The reserve ratio, or the percentage of deposits that banks are required to keep on hand, is set by our good old friend, the Federal Reserve. This ratio acts as a cushion, a safeguard if you will, for those times when customers wish to withdraw their cash. Now you might be wondering, what's the point of all this? Why not just keep all the deposits safe and sound? Well, here's the catch. By lending out the money, banks essentially create more money. Yes, you heard that right. Banks create money not by printing new bills or minting new coins, but through the magic of lending. Let's paint a picture here. Imagine you deposit $10,000 into your bank. If the reserve requirement is 10%, your bank will hold $1,000 and can lend out $9,000 to another customer. That customer then deposits the $9,000 into their bank, which again holds 10% and lends out the rest. This cycle continues, and as it does, the total amount of money in the economy, also known as the money supply, increases. This is the bedrock of banking, allowing banks to lend more than they physically hold. It's a system that's been in place for centuries, and it's how banks continue to thrive and fuel economies around the world. And now, you're in on the secret too. Now, let's delve into the fascinating process of money creation. Imagine you've just received a hefty paycheck and you deposit $10,000 into your bank. The bank is required to keep a fraction of it, say 10%. That's $1,000 as a reserve. The rest, $9,000, is free to be loaned out to another customer. This is where the magic happens. That $9,000 doesn't just disappear into someone else's pocket. It gets spent, maybe on a shiny new car, and then that car dealer deposits that $9,000 into their bank. And the process repeats. The bank keeps 10%, or $900, and loans out the remaining $8,100. This cycle continues with each deposit and loan, creating a ripple effect throughout the economy. Each new loan becomes someone else's deposit, which becomes another loan, and so on. It's kind of like a financial version of a Russian nesting doll. But there's something extraordinary happening here. Even though the original $10,000 hasn't physically increased, the bank has effectively created more money in the economy by turning one person's deposit into another person's loan over and over again. This is how banks increase the supply of money in the economy. It's an intricate dance between deposits and loans, all orchestrated by the bank. But remember, just as easily as this money is created, it can also disappear if loans are not paid back, which is why banks have to be careful about who they lend to. So, you see, when you deposit your money in the bank, you're not just making a simple transaction. You're participating in a complex system of money creation that fuels our economy. And that, my friends, is the magic of money creation. This cycle continues, creating more money in the economy without increasing the physical cash. Here's a thought. Do deposits create loans, or do loans create deposits? Now, We know that banks lend out the money we deposit, which is why they're always eager to attract more deposits. But let's flip the coin. When a bank lends out money, and that money is deposited back into the banking system, we can say that loans also create deposits. Picture this. The bank loans out $9,000 to a customer. This customer then deposits the money into their account, thereby creating a new deposit. The bank can then use a portion of this new deposit to create more loans, and the cycle continues. It's a fascinating interplay, really. Banks need deposits to create loans, but loans in turn generate new deposits. It's a continuous, interdependent cycle that keeps the banking system running. In essence, it's a continuous, interdependent cycle. Banks might seem like they have a money printing machine, but there are limitations. Now let's dive into these constraints that prevent banks from lending out money like a kid with a new toy. First and foremost, profitability considerations play a key role in bank lending. You see, while banks earn interest on the loans they give out, they also bear the cost of running their operations. From paying their employees to maintaining their infrastructure, every penny counts. And let's not forget the risk element. Every loan carries a risk of default, meaning the borrower might not be able to repay the loan. To mitigate this risk, banks carefully assess the creditworthiness of borrowers before lending out money. So, it's not as simple as shelling out loans to anyone who walks through the door. The second major constraint is capital requirements. Now, you might be wondering, what's capital got to do with lending? Well, in the banking world, capital refers to the amount of the bank's own money, or equity, that it has to hold as a buffer against unexpected losses. These capital requirements are established by regulatory bodies to ensure that banks have enough of their own skin in the game, so to speak. So, let's say a bank has a capital requirement of 10%. This means that for every $100 it lends out, it has to hold $10 of its own money. These requirements are crucial because they provide a safety net for the bank, allowing it to absorb losses and continue operating even if some loans go bad. In essence, while it's true that banks create money by lending out deposits, they do so within a framework of regulations and restrictions. These limitations are in place to ensure that banks operate responsibly, maintaining a delicate balance between profitability and risk. So while it may seem like your bank has the power to create money out of thin air, remember, they're also playing by a set of rules. These checks and balances ensure that banks operate responsibly and sustainably. Concerned about the safety of your hard-earned money? Rest easy. In the complex world of banking and money creation, there's a key player working behind the scenes to protect your deposits. Enter the Federal Deposit Insurance Corporation, or as it's more commonly known, the FDIC. This government organization has one crucial mission: to ensure and safeguard your deposits. Now, before you start worrying about the limit, let me reassure you. The FDIC insures up to $250,000 of your deposits per bank. This means, even in the unlikely event of a bank failure, your money up to that limit is secure. So, while your deposits are hard at work, fueling the economy through the magic of money creation, they're also under the protective umbrella of the FDIC. So, your deposits aren't just fueling the economy, they're also safeguarded. We've navigated the complex world of banking and money creation together. In our journey, we've understood that when you deposit money in the bank, it doesn't just sit there. Instead, it's put to work, with banks lending most of it out to earn higher interest. We've also uncovered the intriguing concept of fractional reserve banking, which allows banks to loan out more than they hold, effectively creating money. But it's not a free-for-all. Banks are bound by constraints like profitability and capital requirements, ensuring a balance in their operations. And remember, your deposits are safe, insured up to $250,000 by the FDIC. So next time you deposit money, remember, you're not just saving, you're participating in an intricate process of money creation. If you enjoyed this journey and would like to explore more aspects of finance, don't forget to subscribe, like, and share this video. And of course, leave your thoughts or questions in the comments below. Until next time.